It usually begins with a well-intentioned investor staring at two nearly identical charts. Both show steady upward movement over decades. Both represent broad exposure to the U.S. economy. Both have low expense ratios. Both are recommended by respected institutions. One tracks the S&P 500. The other tracks the total U.S. stock market. The question sounds simple. If they move almost the same, what's the real difference? To answer that properly, we need to move beyond ticker symbols and into structure. Let's begin with the S&P 500 ETF. An S&P 500 ETF, like the widely known VOO, tracks the Standard & Poor's 500 index. That index includes 500 of the largest publicly traded companies in the United States, selected based on market capitalization, liquidity, and profitability criteria. These companies represent roughly 80% of the total U.S. equity market by value. When you buy an S&P 500 ETF, you are buying large-cap America. Technology giants, global banks, healthcare leaders, consumer brands, industrial multinationals. Now consider a total market ETF, such as VTI. A total market ETF tracks virtually the entire investable U.S. equity market. That includes large cap, mid cap, and small cap companies, often thousands of stocks. The difference is not about geography. Both are U.S. focused. The difference is depth. The S&P 500 ETF gives you the top layer of the U.S. corporate ecosystem. The Total Market ETF gives you the entire ecosystem. On the surface, that may sound like a significant distinction. But here's the nuance. Because both funds are market cap weighted, the largest companies dominate both portfolios. If Apple, Microsoft, or Amazon represent a large percentage of the U.S. market, they will represent a large percentage of both VOO and VTI. In practice, over the past decade, the performance of the S&P 500 and the total U.S. market has been remarkably similar. Why? Because large-cap stocks have driven most of the market's returns. But similarity in recent performance does not mean structural identity. The difference lies in exposure to smaller companies. Small and mid-cap stocks tend to behave differently across economic cycles. Historically, small caps have sometimes outperformed large caps during early stages of economic expansion. They are often more sensitive to domestic growth, credit conditions, and consumer demand. Large caps, by contrast, often have global revenue streams, stronger balance sheets, and greater resilience during downturns. So when you choose between an S&P 500 ETF and a total market ETF, you are subtly choosing between concentration and breadth. Now let's introduce data. The S&P 500 includes 500 companies. A total market ETF may hold 3,000 to 4,000 stocks. However, because of market cap weighting, the top 10 companies can represent 25% or more of the S&P 500. In the total market ETF, those same companies may represent a slightly smaller but still dominant percentage. This highlights something many investors misunderstand. Owning more stocks does not automatically mean dramatically different risk. In market cap weighted systems, size matters. But the additional exposure to mid and small cap stocks does introduce incremental diversification. That incremental diversification can matter over long horizons. Let's consider risk. During the 2008 financial crisis, small cap stocks declined sharply, often more than large caps. During the 2020 pandemic crash, both large and small caps fell, but the recovery in certain small cap segments was more volatile. Over multi-decade horizons, the so-called size premium, the idea that small cap stocks may deliver higher returns in exchange for higher volatility, has appeared in academic research. However, the persistence of that premium has varied over time. So which approach wins? Historically, both have delivered strong long-term returns aligned with U.S. economic growth. The S&P 500 ETF offers simplicity and focus. It captures the core drivers of corporate America. It is highly liquid, widely followed, and extremely low cost. The Total Market ETF offers additional diversification, including exposure to emerging companies that may become tomorrow's large caps. There is also a philosophical difference. The S&P 500 index is curated. Companies must meet certain criteria for inclusion. It is not simply the largest 500 by size. There is a selection committee that evaluates profitability and other factors. A total market ETF is more mechanical. It tracks a broader index that includes nearly all eligible stocks meeting basic listing criteria. This distinction is subtle but meaningful. The S&P 500 reflects a layer of quality screening. The total market reflects raw market structure. Now let's talk costs. Both types of ETFs often carry very low expense ratios, frequently within a few basis points of each other. Cost differences are usually negligible. The decision, therefore, is not about fees. It is about philosophy and structure. Do you want concentrated exposure to established corporate leaders? Or do you want exposure to the full spectrum of the U.S. equity market, including smaller, more volatile firms? Some investors blend both, though this often results in overlap because large caps dominate both funds. Others choose one as a core holding and allocate internationally or to other asset classes for diversification instead. And here's the broader context. Over the past decade, the performance gap between large-cap U.S. stocks and smaller companies widened significantly, largely driven by the dominance of technology giants. But markets move in cycles. There have been periods, such as parts of the early 2000s, when small-cap stocks outperformed large caps. No single segment dominates forever. The key misunderstanding is this. Investors often believe that more holdings automatically mean better diversification. But diversification is not just about the number of stocks. It is about exposure to different risk factors: size, sector, geography, valuation. If your total market ETF is still 25% concentrated in a handful of mega-cap technology firms, diversification may not be as broad as the raw number of holdings suggests. So the real question is not which ETF is superior. It is how each fits into a broader portfolio structure. If your strategy already includes small-cap exposure elsewhere, the S&P 500 may be sufficient. If you want simplicity, one fund representing the entire U.S. equity market, the Total Market ETF offers structural completeness. Over decades, both approaches have aligned closely with the growth of U.S. corporate earnings and GDP expansion. The difference is marginal in some periods and meaningful in others. And perhaps that is the most important lesson. Investing is rarely about dramatic differences between high-quality options. It is often about subtle structural decisions compounded over time. So when you compare an S&P 500 ETF and a total market ETF, ask yourself, are you choosing based on headlines and recent performance? Or are you choosing based on how you want your exposure structured for the next 20 or 30 years? Because in long-term wealth building, alignment matters more than perfection. This is Finance Guru, where we don't chase noise, we study reality.